Yeah, it's okay. Okay, we're live now.
Okay.
Yeah, everyone. Good morning, good evening, whatever you're hearing us from. So, welcome back to the channel. Today, just like you have known, we're talking about home ownership or mortgage acquisition in Canada. Yes, and you can see the expert is here with us. We're going to be talking about how to, get your own home here. What are the eligibility criteria? I'll be asking him some questions like we always do, and then you get to also ask him questions once it is time for Q&A. Yeah. So good afternoon, sir. Thank you so much for joining me today. We are so glad to have you. How are you doing? How is everyone?
Yeah, thanks so much for bringing me in as well. I'm excited for the time. I'm doing okay. Everybody's fine. It's beautiful weather. I think,
Yeah, the winter is almost here. I don't think the weather is.
I think it's beautiful for this time, especially at this time of the year. It's not in the single digit yet. So I think we just have to be grateful. So we're liking it so
Yes.
far. Yeah.
Yeah. So please tell us, how did you start your journey into Canada? Like, how did you get here? Let's get to meet you. How were you able to migrate into Canada? What route did you use? And some basic information like that on your immigrations.
Yeah. My name is Abiodun Ario. The first thing I find out was I discovered that Abiodun was.
How is that? Some people are in the studio with me. Did you send the link to somebody?
Yes, I think I.
Oh,
Oh,
the link is for, except the person is going to speak to us on this topic.
no, not at
The
all.
link is for you as my, okay, yeah, the person has to join via my
Your
YouTube
own.
link.
Okay.
Yes. You have to just search for Nosofela. So let me just talk to her. Romy, can you hear me? Can you hear me, Romy? Okay, let me just add you to the stream. Hi, good evening. So you're supposed to, this is
Hello.
for the guest. You are in the guest room right
Okay.
now. So you're
Okay.
supposed to join, go into my YouTube channel, Nosofela, and just watch.
Oh,
But it's
okay. Okay.
contributions,
Okay.
have that link and join us. Yes.
Oh, okay. Okay.
Okay. So sorry about that. Yeah, I don't know why my hair is flying around. You people will manage it today. Whoa, this motherhood that I'm entering, I don't know. My hair is just flying around. I'll adjust it. I'll stand up to adjust it. Anyway, so tell us about your immigration journey into Canada.
Yeah, my immigration journey into Canada started some years back. I think about 10 years back, and I've always, wanted to had a plan to immigrate, and yeah, so we tried several options then, and I think it was 2013 or 2014, 2013 when uh, it was launched that Canada was going to bring in about I can't remember the number now, some thousands, I think about 2,000 or so across Canada that was going to come into about 200. Oh, sorry, I
No
can't get
problem.
all this. I think about 50 professions or so. That was in 2013. They launched that. So I found out that that was a very perfect opportunity for us. Yeah, so
Great.
we applied. By then, it was this paper-based application. Before that was just before they started the express.
Yeah, I heard so. Yeah,
Yeah,
they were
so
doing
it
paper
was
based.
paper-based. So we applied, and ours was very fast. When we applied, in about I think about 6 months or 7 months thereabouts, the whole thing was concluded. Even though there was a little bit delay down the line, but the whole process was very fast, and we just found ourselves here. So yeah, it was quite interesting. Yeah, precisely about 7 years ago.
Oh, okay. So for the paper based, you're then usually write few paper and then mail it to Canada. Or
Yeah,
how was it done?
so yeah, the paper base was that you go to their site, you fill in all the your informations on the
Mhm.
documents, print it out, then validate, print it out, package everything, send it to I think it's Sydney in Nova Scotia at the time. I think it's still
Oh,
the
okay.
same place. So you just send all the document and you begin to wait and wait and wait.
For them to, yeah.
So back in the day, they used to ask us to put like an account, Mastercard that would be debited. So after
Okay.
it's submitted, you now be checking your account to make sure there's this debit. It was the first time I see money leaving my account, and I was happy. So
I can
you just
imagine.
you just waiting for that debit. Then one day I just woke up.
Okay.
I saw a debit to my account that has been Canada immigration, something, something, something. Because that's the only way. So the way it works is that if you send your paper-based application to them, and
Yeah.
if for some reasons it's not accepted, they will just email it back to you, and
But they
that
won't
will
debit.
take, yeah, that will take months and months
Oh,
before you have it
nice.
back. So you won't know if your application is in or not.
Not.
So
Oh, wow.
yeah, that was why. But once you see a debit to your account, then that means your application has been accepted. Yeah, so that
Oh,
was
I mean,
it
I
was
think
there.
I like that too, because it's at least there's something to give you an assurance.
Yeah, yeah, yeah. Once you
Yeah.
see that, of course, that opens up conversation, having communication. Then after that, they will send you like an email saying, "Hey, congratulations, you've been accepted." They just kind of go from there, really.
Okay. So
Yeah.
let's get to the main topic. So what is the mortgage property acquisition and mortgage? What does it really entail? Like when they say mortgage, what does it really entail? What's the mortgage process? What does it really entail?
All right. The word mortgage itself is a type of a loan. So, like in Canada, by the way, my background is banking. Had a brief
Yeah.
banking experience back home in Nigeria before I immigrated to Canada. I worked in I think, about four different banks in Nigeria before I moved over here. So I have about
Oh
18
wow.
years banking experience. 12,
Amazing.
12 or 15, 11 or so years in Nigeria, then about 6 or 7 years in Canada. Actually, about 7 years in Canada,
In
banking environment.
Canada.
Yeah. So
Wow.
the word mortgage itself is a kind of loan that we have two types of loan. We have secured, then we have unsecured. So mortgage is a
Okay.
kind of secured loan that has to do with real estate. So like if you're buying a house, it's not just called a loan; it's called a mortgage. So mortgage is a kind of loan that you get to finance secured asset, usually a house. Yeah, that's the word mortgage. And the word mortgage is a way of helping you to acquire a house
Okay,
without
now.
necessarily having to put down 100% of the house. Unlike what happens in some part of the world where you can't get a mortgage, but here mortgage is so easy to get. Especially you just need to
Yeah.
some few items or some few things in place, and you're good to go. Yeah.
Thank you very much for that. Yeah. So, what are the essential? What are the things I must have as an individual before I can say, "Oh, I want a mortgage in Canada"? What are the essentials? Are there
Uh,
things I must have? Time job? Can I get it with a part-time job? Things like that.
Okay, thanks so much for that question. I think that's really bring me into the heart of the conversation today. Uh, as in Canada and like any other part of the world, there's one thing that is very key. If you're going to get either a mortgage, you're going to get a line of credit, or you're going to get a vehicle loan, any kind of loan, or even credit card sometimes. Now,
Mhm.
in Canada, we are very strong about what we call 5 C's of credit.
Okay.
So that's very, very critical to you getting a loan here. Number one, we look at your credit itself. How is your credit? That's the most important one. So your credit,
Okay.
you must do your best to make sure you have a very sound, good credit. We have two bodies in Canada that kind of regulate credit. We have TransUnion, and there's another body also. What this guys does, and I know there's a little bit of something like that also back home in Nigeria now. But in Canada, these guys they monitor your credits. They look at how you're performing, and they apportion a number. A number
Okay.
is apportioned to your credit. So usually it's over 900. Now, if you
Okay.
want to buy a house in Canada, you have to at least have a credit worthiness of at least 600 and over. If your
Okay.
credit is less than 600, you probably gonna have some very hard time getting a house. So
Oh,
the first big one is your credit. Of course, the second one that is equally as important is capacity. So in Canada, as a mortgage and any other loan, they look at your capacity. So your capacity has to do with your income. How
okay.
much are you earning? Usually, there's what we call, and I know it's also the same thing with Nigeria, even though it's called by a different name. There's what we call here in Canada, we call it TDSR. So that's your total debt service ratio. So what that means is the percentage of your debt versus the percentage of your income. Like,
Okay.
like for example, if you are on a salary of $1,000 a month, your percentage of all your debts added together, like, okay, you have a vehicle loan, you have a student loan, you have this other loan, how much you used to pay back all those loans at the end of the month must not be
Mhm.
more than 40% of your
Of
income
what you earn. Oh,
of
wow.
your hand. So a guy that had $1,000, for example, we are
Mhm.
looking at 40%. That's gonna be, that's gonna be $400.
Yes.
If you have a car loan, you have a credit card, you have a personal loan. If we had all those amount you used to service all those loans, if they're already $400, you're not going
Yeah.
to qualify for any house
Not
because
going
you
to qualify.
have exceeded your TDSR. So that's
Oh,
very critical. You have to make sure your income is part of it, your capacity is part of it. And of course, the biggest issue when it comes to owning a house in Canada is usually your down payments. So
yeah.
because in Canada, they're not gonna give you a house that is 100% financed by the bank. They want your commitment because in the past we've had people, they got a house, they got a mortgage, and they just walk away because they don't have their input. Their personal money is not in the house. Let's say, for
Hmm.
example, like what happened in 2008, the global financial meltdown, where the prices of house were lower than the loan balances. So what I mean by that,
Hmm.
you got a house for 500,000. Due
Mhm.
to the price of the house going down, now you now discover that the house that you bought at 500,000 5 years ago is now worth 200,000. So what people simply do, they just walk away. So why would I
They
owe
just want to.
yeah, why do I owe the bank 400,000 balance on my loan when I could buy the same house now for 200,000? So what people did then was they just walk away because they don't have stake in the house anymore. So that's one of the reasons why the bank introduced the issue of a down payment, that you have to have your down payment, and usually your
Yes.
down payment has to be 20%, or basic minimum down payment will be 5%. You have to have your 5% up to, you could have 5, you could have 10, you could have 15, you could have 20%. Your but basic to buy a house,
Basic
you have your 5% minimum
five
down
percent,
payment. Yeah,
5%
yeah,
minimum.
to be able to buy it.
Okay, so when you mentioned the income part of your what you spend must be 40% of your income, like your TDSR. So
Yeah.
if I'm single or if I don't have a partner, how does that work? Or if I have a partner, how does it work?
Unfortunately, in Canada, if you don't have a partner or you have a partner that is not uh, working at the time, so what that does is that it's going to impact greatly on what kind of house you're going to be able to buy. By the way, for folks listening to me, in Canada we have different kind of segmented houses. We have what we call condominium, which is more like an apartment, back home, like high-rise buildings where you have multiple units. Then we have the townhouse, which is gonna be like well, maybe four plus, like four houses, four units attached. Of course, we have the duplex. We have the duplex, which is gonna be like two units attached, and then we have the single family house. So when you have a single income family, no matter how much you earn, the implication of that is that you're not going to be able to qualify for a big house because the bank don't really care as much if it's one income or two income. They don't really care
Okay.
as much.
Don't really care.
What the bank just does is that what is the available household income? If it's
Okay.
by one person or by two people, it doesn't really make any much difference to bank. Because what we'll do is that we'll just take your income, plug it into the system, and you have your maximum approved loan amount. And that's what we go
Okay.
by. So that's what is going to determine what kind of house you're going to be able to buy eventually.
Okay. I get that. Thank you so much. That's so interesting. I like financial conversations because they kind of open my mind.
Yeah.
So somebody when I posted my flyer, somebody was asking if foreigners can buy homes in Canada. Like if I'm in Nigeria and I have the money, can I buy a home in Canada while I'm still in Nigeria?
Yes. Foreigners can buy house in Canada. Depends on what part of the world the foreigner is living in. The only difference is your down payment.
Okay.
Because the bank feels like when you are outside of Canada and you're buying a house, I just talked about the credit reporting agency. So
Yeah.
we are aware that if somebody is buying from the US, for example, it's a lot easier because US and Canada are kind of like integrated.
Mutual.
We
Yeah.
can obtain your credit report from US. And I have an example of a Nigerian who was working with a multinational back in Nigeria, and he was transferred. I think the company he works for transferred him to the US, and from US to Canada, in fact, to here in Edmonton. So the guy was
Okay.
working here in Edmonton and he was going to buy a house, and well paid. He makes over 100 grand. But the issue with him was that he has zero credit report in Canada and also in US because he just
Oh,
moved to US. That US further relocated, brought him down to Canada. So
Canada.
what the guy did was and that was when I got to know that there's some credit reports agency available in Nigeria now. I don't know how
Oh,
far, yeah, I don't know how far that is. So yeah, I think it's called CRC or something. So the guy went back to Nigeria, wrote back to his bank in Nigeria, and they were able to send his credit report. They sent
credit
it
report.
to us here, and we did some special approval, and the guy was approved. Now, the way it works is this: if you are in Nigeria, you want to buy a house here, yeah,
Mhm.
it's possible, but your down payment has to be higher than normal. So your down payment, rather than somebody who lives here, who works here, need about 5% minimum down payment to be able to buy a house. But if you live back home, you're gonna need about 30 to 35% down payment.
Yes, absolutely.
Yeah, that's the implication of that.
That's the implication. Okay, yeah, there's a question I was supposed to ask from the previous discussion. So for people who have part-time jobs, does it work for them to get
Oh yeah,
mortgage in Canada?
absolutely. Yeah, if you have a part-time job, what we do with part-time job is the banks want to make sure your part-time job is permanent. Uh,
Okay.
so you cannot have a part-time job that is inconsistent. Like let's say
Okay.
this week you work 10 hours, next week you work 8, upper week you work 20. We won't work, bank won't work with that. So what the banks want is that give us your fixed hours a week. If
Okay.
it's going to be eight,
Okay.
because the reason is because we need to pick an amount, and how we calculate your amount is your hourly rate
Yeah.
multiplied by your numbers of hours a week,
Yeah.
multiplied by
Yeah.
52 to get how much you make a year. So if there is no fixed amount, fixed hour, then it
There's
becomes
no.
impossible. So you can get a house with a part-time job. What we need, that's why usually when you are working a part-time job and you go to the bank will ask you, go back to your HR and let them give us guaranteed hour. How many hours is guaranteed? And let me quickly chip in this. We have situation where somebody has a full-time job and they now have a part-time job on the side. Yeah, you
Hmm.
can use your full-time job, but you can also use your part-time job. But the problem with the part-time job is that in that regard, you need to get a minimum guaranteed hour.
Oh.
And once you start going into a second job, then the bank wants 2 years history. Most banks, and I must say at this junction also that in Canada, we have about three types of banks. So we have
Okay.
what we call category A, then we have category B, then we have category C. So category A bank, they are called first lenders. There are about 5 banks. These banks are national, in nature. You see them in every province you go to, and they are the big five. They call them the big five. So
Big
these
five.
big five, they are federally regulated. So if you go to, I don't know if I could give an example on your channel. If you go to, TD, you go to BMO,
Yeah.
Scotia, RBC, and
Yeah.
CIBC. You go to
See,
either of these five, the policies are similar. It's almost, if Bank A said this, most likely B will also say
you
that.
say that.
Because their regulation is the same.
Criminal.
Yeah, it's similar. Of course, there's also category B. Category B might be regional registered. Like we have the Canadian Western banks, and I know there's another one in Ontario as well. So these banks, they are regionally regulated. Now, then of course we have the provincial one. Uh, the basic difference. Do they want attention? You also want to speak there?
Yeah, if you don't mind, I'll put him on my back now.
No, okay, no problem. I can just continue. Yeah, so
Yes, sure.
these banks, their requirements differs. So their requirement differs. The when I talk about the part-time job, so the requirement will differ depend on who you are speaking with. If you are speaking with a
Yeah.
category one bank, those ones might be very strict when it comes to documentation. Of course, their interest rate is also the lowest. So when you move
Okay.
to, for example, category C, they can let you get away with some things. Of course, the interest rate is higher. So depends on what's most important to you. So you could get some things waived, but again,
Mm-hmm.
you are paying the price you are paying will be higher interest rate. Yeah, when you
I
go,
get that.
yeah.
Thank you so much. As in this, that's why I'm listening very attentive because I'm really um. So for the payment plan, how does it work? How does it? So if I pay my 5% from that
Yeah.
time, how does my payment plan work? After paying my 5% and I fit into all criteria, how does my
Oh,
payment plan work?
yeah, thanks for that. That's actually a very good question. In Canada, so most mortgages are for 25 years. The amortization
Okay.
period is for 25 years, even though you could
Okay.
do 30 years. Now, but what the bank does is that
And
if
not,
you
I'm not done with paying.
are not
You mean
repay,
25 years? I might not be done with paying.
are not repay, sorry, I
No, I
didn't.
mean, it said amortization 25 years.
Yeah,
Does it mean in 25 years I won't be done with paying my mortgage? I'm
that
just
means you'll
asking.
be done. Amortization means that you'll be. It's going to be for 25 years. That means you have 25 years to pay down the mortgage.
Okay, okay, okay. I was
Yeah.
trying to understand that. Okay.
Yeah, so most mortgages are usually for 25 years amortization, but
Mhm.
some people do 30 years, some people do 35. Now, the longer your mortgage, the lower your monthly rentals. So what you pay
Okay.
monthly will be lower. Of course, if you go 30 years, then your mortgage amount every month is very low. Of
Very
course, you
low.
pay a whole lot in interest also. So
Yeah.
you drag your mortgage, then your interest is longer and more and higher. So this is the way it works, really, basically. Now, if you have a, a 5% down payment, they don't allow you to go more than 25 years amortization. So if your down
Okay.
payment is only 5%, or 10% or 15%. If it's less than 20%, you can only do 25 years amortization. They won't let you go more than 25. But if your
Okay.
down payment is 20% and over, most banks
Mm-hmm.
will allow you to go on amortization of 30 years. Now, what's the benefit
Okay.
of that? Why would anybody want to do that? The reason why people could want to do that is that if I have a bulk amount of money with me now, and I want to throw that into my mortgage and now have, and so that to reduce my monthly rentals, I could put all those money in there and now have My mortgage, instead of 25 years, have it for 30 years. That means my every month renters is now reduced. It's something that is
Now
now, yeah, it's reduced. Yeah, that's the way the monthly
that's the
rent.
way.
Of course, and another thing also to bear in mind is that if you do your down payment of 5% in Canada,
Mm-hmm.
there is what we call mortgage insurance.
Mortgage
So the
insurance.
mortgage
Okay.
insurance started since the 2008 global meltdown, especially as it had serious impact in the US. So what the Canadian banking environment did was to set up like a plan in case that kind of global meltdown happens again. The Canadian uh, economy will not be impacted at all. So what they did was that they set up like a mortgage insurance that anybody who is buying a house in Canada, uh, who is putting down payment of less than 20% must get
Mm-hmm.
insurance.
Must get insurance. Okay.
Must get insurance, and it's get mortgage insurance. Now, what they do with this insurance, if you put a down payment of 5% down, you will be paying 4.2%, 4.2% of your total mortgage amount. Let's say, for example, you're
Okay.
buying a house of 300,000
Okay.
and you put down 5% down payment. So 300,000, 5% will be 15,000. So you put down your 15% down payment. If you
Yeah.
take away 15% from 300,000, sorry, if you take 15,000 out of your 300,000, so that means your mortgage amount should be 285,000, right? As
Yeah.
in the first day of your mortgage, when you open your computer, you should see 285. But that's not what happens. So what about, because your down payment is only 5%, they will now charge you additional 4.2% of 300,000. So when you multiply 4.2% of 300,000, it's going to be around maybe 11,000 or 9,000. I can't be exact now. Maybe around 9,000. So what the bank does is that the 9,000, you don't pay it out of your pocket. Is the 9,000 is added to the 285,000, so that your
Okay.
mortgage amount is now going to be 284,000. Sorry, 294,000. Do I make any sense? Should I explain that again?
Yeah, I think I'm trying to get it. Like, okay, that insurance is not, that means, because I know there's one who pay monthly, no, yearly. Um something something tax, homeowner tax or whatever. I know there's someone who pay
Property
yearly.
tax?
It's not that one. Property tax. It's not that one, right? It's not property
No, no, it's
tax.
not. This also okay. In Canada, when you want to buy a house in Canada, there are three insurances. The number one is this one. This one is government regulated. This one is important. It's not optional. You have to get it. It's not even your bank. It's the it's the government of Canada.
Yeah.
So once your down payment is less than 20%, you can't escape it. You have to pay it. And it's usually depend on the percentage of your down payment. If you're, like I said, if your down payment is only 5%, you are paying about 4.2%. If your down payment is 10%, then it's down to about 3.1%. If your down
Oh,
payment is
yeah.
15%, like that, is graduated. Now, so
Yes.
that's the first form of insurance. Of course, the second insurance is fire insurance, flood insurance. That one is also compulsory, but it's imposed by the bank.
Hmm.
Before the bank will give you the mortgage, of course, they insist that you have to go get an insurance. And that's to protect the bank in case there's a fire on the house that you're buying. They want to make sure the insurance is going to pay them back. So
That
that's the second forms of insurance. Of course, the third forms of insurance is optional. That's what we call payment insurance. Like if there's a loss of job, you lose your job, you couldn't pay back. That insurance comes in, and that one is usually very optional. If you
that
want to
one's
get
optional.
a house in Canada, the bank will talk to you about that one. You have an option of saying yes or no. That's optional. But the first two is not optional; it's compulsory. Of course, or even though the first one is based on your down payment. If you do a down payment of 20% and over, then you're not paying that. But if your down payment is less than 20%, then you pay that. Yeah. So that's the way the insurance thing works.
That's the way it works. Okay. So for the basement, for people who rent out the basement, government does not have any regulation on that, right? If I rent out my basement,
Uh, Depends on what you mean by government does not have. Of course, government have regulations about that.
no,
Uh,
like no, I mean what I mean is, do they take? They don't have anything to do with the money I make when I rent out
they
my
do.
basement.
Of course, they do. The government, they
How?
have.
How? Okay, what's the letter on that one again?
Yeah, yeah. The government have everything to do with every income you make in Canada. So depends on if you're doing it under the table or you're doing it, like when you're doing it, when you have a legal basement, if your basement is legal, so what that means is that it's approved by the city to be used for basement. Of course, the government wants you to report whatever extra income you make from that. Yeah, that's going to be an expert, like an accountant that can tell you how
Yeah,
to what you can use. But
how to go about that?
what they do is that it's usually go by the square foot of your house. So if you have 3,200 square foot, for example, and you have three layers of house, so you have the basement, you have the first floor, then you have the second floor. So and you have 3,200. So what the government does is that they divide all your bills. Let's say your property tax, the one you mentioned, your other utility bills is divided into three, and a third portion of that can be applied to. You can use it. You can remove your income from the basement. You can remove it from that. For example, what I mean is that if your property tax is 3,000, for example,
Hmm.
because that 3,000 is for the entire house, and the portion you are renting house, you can remove the one third or 33% of the income, or sorry, 33% of the property tax can be removed from the income you made in the basement. Yeah, so that's the way it works because the basement is going to be counted like a business. It will
Hmm.
look as if you are doing a business in your house. So
Yeah.
all the utility bill, a portion of it, about 33% of that can be used to write off part of the income you make in the basement.
Yeah, I know about that. I know about that write-off thing. Thank you so much so far. So what is the best time to buy a home? Is there any best time to buy a home in Canada? Like maybe talking about inflation, the price you get, and maybe any other advantages of any the best time to buy homes.
Well, every time is always the best time to buy a house in Canada because one of the reasons why it's very good to buy a house is because if you don't buy, you are renting.
Yeah.
If you're renting, you are paying somebody else's mortgage.
Yeah.
And the way it works is that if I buy a house today and I start paying my mortgage, what that means is that most houses don't stay the same price after 2, 3 years. So a house
Mm-hmm.
that you buy today at 100,000, in 2 years' time is going to be around 110, right? So the house value goes down, the mortgage value keep going down, right? So and the best form of saving for retirement in Canada is through a house. So when you buy a house, every month you pay your mortgage, you're actually saving that money. Because
Mm-hmm.
after 25 years, you have fully paid off your mortgage, the house becomes fully yours. You
Mm-hmm.
can sell the house and have a whole lot of money for retirement. So, in terms of time, what's the best time to buy a house? Every time now. But if you are talking about government policies and all of that, usually it's better to buy a house when the interest rate is low. It's
Mm-hmm.
usually the best time because the higher the interest rate, of course, the higher your renters. Your renters is going to be high if you're buying when the interest rate is high. Like right now, interest rate is very high. When you're buying a house right now, it's going to be a lot difficult even for because the bank normally approve you based on the interest rate. And in
Okay.
Canada, there's what we call stress test. So that was brought in by the government about 5 years ago. So they call it stress test. Now, stress test means adding about 2% to
Wait.
the interest rate that you'll be paying. So let's say the interest rate is going to be 5% that you will be
Mhm.
paying when you get a mortgage. So the bank want to know that what happens if the interest rate is increased from 5 to 7. Are you still going to be able to pay
So,
for the house? So instead of us giving you the mortgage at 5%, we'll do a test. It's called stress test. We will
okay.
calculate based on your income. If the interest rate goes to 7%, are you still going to qualify? So we approve you based on 7%. So when it comes to time, when is the best time? Of course, when the interest rate is high, you will qualify for less mortgage. So it might not
Okay.
be the best time to buy. It's the best time is when interest rate is low. You can qualify for a big house if you want, right? Some people don't want a big house; they just want something okay for their family. You're right, but yeah, the timing of things will be when interest rate is low. It will be the best time to
Interesting.
buy.
Would be
And
the best
again,
time to.
in Canada, generally, again, because of our unique place in the world, because of the cold, usually people tend to buy a house a lot. There's a rush in the summer. Usually
Yes.
in the spring, like this year, we had a very serious run in the market in March, April. It was as if the whole Canada were buying a house. Of course, that also contributed to the driving up of the inflation that we're experiencing right now. Because everybody wanted to buy in March and in April. Houses were going up like, a house that you saw yesterday at 300,000 today is now 320,000. Of course, that's already cooled down now. So, if you want to avoid the rush, it's usually better to buy before the rush starts in about March or April. Yeah, so I would say if you don't mind the winter, you want to move in the winter to your new house, you could buy at a time when the market is cooled down, and that
Okay.
will
So the winter time is the
yeah,
market
when
is
it's
less.
cooled down. Even the sellers don't have buy, they don't have people who want to buy. So
Exactly, because it's
yeah,
cold and everybody doesn't
it's
want to
cold.
move
That will be
around
the best time to buy. If you again for you also, it will be stressful moving your loads into
during
a
winter.
place when it's minus 20 degree outside, right? So that's why.
We
But
actually moved during winter into my home,
yeah,
but
it's
it was not when it started. It was not the big wing. It was still very small. So we moved
yeah.
around winter. Yeah, moved around winter. So from what I discovered so far, if I don't buy a home in Canada, if I keep renting, then I'm paying the mortgage of the
Yeah,
landlord.
of course, you're helping the owner of the house who equally, and usually from experience, I won't rent, most people won't rent out their house less than the mortgage amount. So
Sure.
if I have a house and my mortgage is $1,000, I will rent it for you at 1,100 so that I make, in most cases, of course, there are some
In most cases,
exceptional
yes.
cases. Most cases, what you pay for rent is usually higher than what you are paying for mortgage, right? So if you keep on renting, it's good for the landlords. And why do people keep renting? Yeah, anybody could approach the bank and get a loan. Why do people keep on renting? It's because bad credit. When your
But
credit is bad, no matter how much your income is, even if you make $10,000 a month, if you have bad credit, the bank doesn't want to talk to you. They don't want to give you mortgage.
mm,
Or the few ones that might give you mortgage, they could give you mortgage for as high as 14%. And when you get a mortgage that high, it's gonna be a lot of struggle. Yeah, so that's
mm,
why people continue to rent because they cannot qualify for a house themselves. Or maybe they don't live in the city, maybe they move from other city, they just want to work for a few hours of a few months and go back. That's another reason why people don't buy and they just prefer to continue to rent.
so what are the ways to avoid bad credits? If I'm a new as a new immigrant, what would you advise a new immigrant? Because new immigrant people are coming to Canada every day. How do they avoid bad credit so that they can, qualify for government loan or get their housing mortgage loan and all that?
Yeah, that's a very great question. I'm glad you are raising this question because, particularly, we've had issues, very serious issues among immigrants when it comes to credit. Because and what's happened is that either be the Africans, the Japanese, the Indians, people from different part of the world. What happens is when people land here, I don't know, maybe because where they're coming from, the credit system is not as advanced as it is here, or maybe just people just throw caution into the wind. When
Mm.
you land in Canada, depend on your status really. If you come in as a student or you come in as a permanent resident, or you come in even as a foreign worker, the bank will give you a credit card without any income. Like you can land in Canada today and get a credit card tomorrow. They just give
Yes.
it to you. You don't need to have started working. Even if you are an international student, no job, nothing, they give you credit card. Of course, it's free money. Most people spend this money. And the way credit works in Canada, for example, credit card, which is one of the cheapest that put most people in trouble with their credit.
Exactly.
You get a credit card for $1,000 and you go to Walmart, you spend $200 there. What the bank wants you to do, you don't have to pay back the $200 at the end of the month. First of all, we have what we call grace-free period. Sorry, grace period. That's interest-free period. Now, if you spend $200 out of your credit card, you don't
Mm-hmm.
have, if you pay back the money to the bank, that's the $200 you spent. If you pay it back fully before 21 days, you are paying zero interest. No interest is paid to the bank at all. The bank doesn't make a dime from you.
Mm.
So people who use their credit card and pay back within 21 days pays nothing to the bank. You just using it, and the bank gets nothing from you.
Oh.
Course, if for some reasons you cannot pay back the $200 in 21 days,
Mm-hmm.
the banks want you to pay what they call minimum payment. So on the
Okay.
$200, for example, your minimum payment is going to be about $10. You cannot give us $200 you spend, please pay minimum, which is going to be about $10. Now, what destroys
Yes.
most people's credit is that they use the credit card, they don't pay back even the minimum $10.
Oh.
You miss the payment 3 times, of course,
Mm.
it gets escalated. Once you miss it, of course, it's going to affect your credit right away. If you miss your payment, so the number one thing that affects people's credit, number one, is when you miss your repayment. When you don't do your
Yes.
repayment in time, when you miss it 3 times, of course, it's going to affect your credit. Number two thing that affects credit in Canada is huge utilization of your credit. That's the second thing. Now,
Mm.
again, how does that work? You have a $1,000 credit card. You have used $990 of the 1,000 limit. Your limit is 1,000. You have used $990. What the message you are sending to the bank is that I really need this your money to live. If I don't have this credit card, I can't survive. Of course, the bank doesn't like that. So that automatically drag down your credit. Your credit just go down. So if you want to avoid that, what to do is to make sure you stay less than 40% of your credit limit. If I have a $1,000 credit card, I make sure I never spend more than $400 at any time. If you know
Okay.
you're going to need to spend more than $400, go to the bank and ask for limit increase. Let the bank
Okay.
increase. And I must say this. So if I have a $10,000 credit card and I spend $4,000 and I'm repaying my $4,000, I am considered better by the bank than somebody who had $1,000 credit card and used $700. Even
Oh.
though this second guy has only used $700, me, I've used $4,000, but the bank look at percentage of utilization, not the amount. The guy that with a
Okay.
$10,000 credit limit has only used about less than about 40%. But the guy with 1,000 who has spent $700 has used 70%. So that's the way that works. Then the third thing that destroy people's credit here is recent frequent inquiries. So every
Mm.
time you approach a bank, so when you do a credit check, so when you do a credit check, there are two types. There is what we call the soft and hard check. So every
Okay.
time you go to a bank or your Walmart, you know how you go to Walmart, they say, "Oh, we want to give you credit card, just fill this application." Uh, or,
Yes.
or you go into the store, maybe bricks, they say, "Oh, just fill this, we'll give you this card." Now, every time you do that, they do a credit check, and the credit check they do is hard. So hard means that they will pull up your credit history and check it. Now, if
Mm-hmm.
you do that more than 4 times a year, it's going to drag down your credit. So
Oh,
you don't need it, avoid it. Avoid hard check until you really need it. If you're not buying a house, you're not buying a car, you're not buying something sort of, avoid it. Don't do it more than 4 times a year. So yeah, that's something that affects
but
people's.
we won't know because they just give us and say we fill this. We can give you. You know, they say we can give you finance on this. Or fill this form, and then you have points or whatever. They give you a card.
Yes, yes,
They give you
it's
a card.
good.
But
It's good,
you
but
know,
go ahead.
avoid it if you can.
Yeah, if you can avoid it, unless it's absolutely necessary. If it's not necessary, yeah, just avoid it because it drags
This
down
is
your
so
credit.
interesting. Your credit so interesting. I remember when I got to Canada, I'm not sure I was up to a week or maybe after a week, I got my credit card. I'm like, this country, this
Yeah,
they even
yeah,
gave me a credit card of $3,000. I'm like,
yeah,
this is really good.
yeah.
But I already know the concept of credit cards, so I was very careful not to buy more
Let's,
than what I don't need and then start paying back because I hate debt in every sense of it.
yeah,
Okay, so there was something somebody asked me when I posted the flyer. The person was asking about fixed and variable in terms of interest and
yes,
payment.
yeah.
So what does that entail? Because the person was mentioning that some people get their mortgage increase along the line, some have a fixed amount, the what they pay every month. So how does that work?
Well, I'm glad you asked me that. That's a very great question, especially at this time. The reason is the concept of variable and fixed rate mortgage. Which one should we go for? Should we go variable? There's
No,
never
let's
been, sorry?
for variable. Anyone is fine.
Well, anyone is right. Well, it depends on the benefits and the that you depend on your situation really. So
Okay.
the way fixed mortgage works in Canada, usually most your mortgage, even though it's for 25 years,
Mm-hmm.
the banks only fix your interest rate for 5 years or
Okay.
7 years, but the most common is 5. And the way that works, excuse me, the way that works is that the banks kind of like they know that conditions do change. So because
Mm-hmm.
conditions do change, they don't want to give you a rate that is going to be around for 25 years. So every 5 years you have to renew the terms, you have to renegotiate, you have to go back to the
Wow.
bank and negotiate. So if you and that's why they fix rate. So when you get a rate from the bank, it's usually
Mm-hmm.
fixed for 5 years in most cases. So that means nothing happens. Your fixed amount is the same for the next 5 years. If it's 3%, it's going to be 3% for 5 years. The disadvantage of that is that within those 5 years, let's say rate drops
Okay.
by let's say for example COVID happened, the Bank of
Mm-hmm.
Canada reduced prime rate and rate went down. If you're already on a 5% fix, you can't do anything, you won't benefit at all. You have to wait
Oh,
5 years
you won't
before,
benefit. Wow.
yeah, before, even though the rate has gone down, of course you're already fixed, you are fixed for the 5 years. You
Certain
just,
amount.
yeah, and your amount, your monthly payment is fixed. Another
Mm-hmm.
disadvantage of the fixed rate mortgage is that you cannot break that mortgage. So if you break the mortgage, let's say something happened, you just want to move from one province to another province and you need to sell your house. If you go to the bank, they will charge you a penalty to break it because it's fixed. Don't forget, the rate is fixed. Because it's
No, but if
fixed,
I sell the house, if I sell the house to somebody else and the person keeps paying the money, is there a problem? Like if I don't
you
inform the
cannot.
bank, I'm going.
You cannot sell the house to somebody and the person keep paying. He has to go through the bank. He has to go through the city. He has to get involved with a lawyer. So don't forget that a house that I bought in my name is in my name and the name of the
Mhm.
bank registered with the city. For example, City of Edmonton or City of Toronto or City of Calgary, wherever you are. So you cannot just say, "Oh, I want to sell to this person," and the person keep on paying them. No, you have to officially sell it. And to officially sell it, it has to be paid off. Your name has to be removed. It has to be transferred legally to this next person. Now,
Oh.
when your name is being removed, you have to pay penalty to the bank. You have to pay penalty.
But the person will keep paying the bank. What is the problem?
Yeah, but because
Why
it's
are
a
they
legal, because it's a legal thing, you cannot just transfer and say, hey, banks, I'm walking away. This is going to be the new guy that is going to be paying. You're almost talking as if it's a no, they don't do that. It has to be properly done and documentation has to happen, right? So that's
okay?
why you
So
can
that's
not.
fixed.
Yeah, you cannot. So that's fixed. And sometimes, depend on the value of your mortgage, your penalty on the fixed mortgage could be as high as 20,000 penalty for just paying off
Wow.
your mortgage.
Where would I get that one from?
Yeah,
I've never seen the province.
don't forget that you are selling your house, right? So if you buy a house now, you are selling. Most people pay it out of their profit. Usually,
Okay.
in most cases, people make money out of
Okay.
their out of when they sell their house. So they pay the penalty from there. Now that's fixed deposit. Sorry, that's fixed mortgage. When you're talking about variable, on the other hand, so variable is usually tied down to the prime rate. Now,
Okay.
so what the bank does is that depend on your negotiation, it could be prime minus some percent, it could be prime minus five, or sorry, minus zero point 0.8, minus one. So, or prime plus this. So the way they do that is that the variable rate is attached to prime rate. So the prime rate is determined or announced by the Bank of Canada every 3 months or sometime every 2 months. Now, so the Bank of Canada meet and say prime rate. Now, the prime rate is the rate at which the commercial banks borrow money from the government. Let's say a bank want to go to the government and borrow money. The
Mm-hmm.
rate that will be applied is called the prime rate. And so that's the rate that normally drag the economy, either slow it down or move it forward.
Oh, bring it up. Hmm.
Yeah. So, for example, the Bank of Canada discovered that inflation rate is high. Many people have too many money. They can go to bank and do things. People have so much money. You know what they did? They increased the prime rate. When they increase prime rate, is to take away more money from people so that people's buying power will reduce.
Yes.
Now, what happened with that is that once prime rates increase, variable rate also goes up. So if you have a house and your house is variable
Mm-hmm.
and you're on 2%, now immediately variable rate, prime rate goes up, your rate will also increase. Once
Oh,
your rate increase, your monthly payment will also increase. Now, what's the advantage? The advantage of it is that you can convert your variable rate to a fixed rate at any time without penalty. Let's assume
oh,
I'm on variable rate. Now, I now learned that fixed rate is down, is lower. I can say, hey, I don't want this variable rate again. Move
I
me
can
to fixed.
switch.
You can do that. But the guy on fixed cannot move to variable
Cannot move to
without,
variable.
without penalty. Now,
Oh,
the
so
guy, sorry.
mhm. No, continue, sir.
Yeah. So the
I'll
guy
come.
on variable can
Mhm.
also break that mortgage. He can, let's say you want to move, like the example I gave, or want to
Move to
sell,
other province
you
or
can
sell.
sell with less penalty. You still pay penalty, but the penalty is low if you're on fixed variable close. So there's what we call variable close and variable open. So variable close means that it's also going to be for 5 years, but it's variable. You can break it with only minimal interest. Yeah, that's the way
Okay.
that one works. Now, to answer the question directly, all I've done so far is just to explain. The real
Yeah.
answer, which one is better? Which
Yeah.
one
Which
should
one?
you go for?
Which one? Yes.
Variable
You go
or
for.
fixed? Depends. Historically, if you look at the last 20 years, variable rate had always outperformed fixed rates
Okay.
in most cases because variable rate had always outperformed if you compare the two of them, the same mortgage, the same interest rate, the same condition for 10 years. Variable has always outperformed. But this year alone, variable rate has been, this is September, variable rate
Yeah.
has been increased about 5 times. That has not happened, I think, since 1982 or so.
About five
Like
times.
that 5 times we've had interest rate, prime rate increase about 5 times, and I don't think we are done yet. I think it's still going to be increased. So is variable rate still okay? Depends on people. Yeah, so I think it depends on if you need to decide should I go variable or fixed. Maybe you need to talk to your banker and
Yeah.
be able to look at your circumstances and advise you. But I think variable rate is better. Of course, that can be countered by anybody. I think variable rate is always better than fixed rate.
Than the fixed rate. Thank you so much. This is really insightful for me. I'm learning quite a lot. Thank you so much. So yeah, so for those that are interested in the business aspect of it, like if I want to do Airbnb, how does it work? I want to is it the same, is there any process is there any process that differs, or is the same way I go to the bank, take a loan, then loan it out, or how does it work?
Yeah. Yeah, the Airbnb, if you go to a bank and you have an intention of buying a house for Airbnb, or maybe not Airbnb for renter, either you want to
Yes.
buy a house, either you want to rent it out, or you want to use it eventually for Airbnb. It differ. The process is a little bit different from when you're buying a principal residence. So what the bank does in that case is that your down payment, once you tell the bank I want to buy this house and it's going to be for renter, your down payment has to be minimum of 20%. So
Minimum.
yeah, minimum. They will not let you do 5. They will not let you do 10. You have to have minimum down payment of 20%. And of course, with rental property or Airbnb, your interest rate is also higher. Your interest rate is higher. If every other person, principal residence buyer, if somebody is buying a house for principal residence and they get interest rate of 2%. If you are buying for rent or for Airbnb, your interest rate will be about 3%. And don't worry about that, because the interest rates you are getting is written off. All the interest you are paying to the bank is written off when you file your taxes. So you're literally going to get
Oh,
that money back. So that's why the banks increase it, because they know that when you file your taxes, you get all the interest you paid back. Now, so either Airbnb or just for regular rent, it's okay. It's the same process that we have itemized before. The only difference is that you need minimum 20% down payment. Of course, some people buy this house for rent or for Airbnb and they lie to the banks that you know it's not for
right.
commercial, that it's going to be their principal residence. So
Yeah.
the banks still charge them minimum 5%. Of course, after they buy it, they now use it for Airbnb or whatever they want to do.
Okay, so for that aspect now, does is it the same as selling to somebody? So it means if I do that, like if I buy it for my own commercial self and then I use it for Airbnb, there's no penalty.
There's no penalty really. Most banks don't really care. Once you already buy the house, what you do with the house after you bought is
Oh,
yours,
okay.
right? So they don't really care that much on it. Even though the bank wants you to notify them if the house is now going to move from being a permanent residence, for principal
Oh,
residence into a commercial. They want you to tell them, because your rate will change, right?
yes.
Or you wait until the time of renewal. When you want to renew, that's usually going to be after 5 years. Then you
Yes.
let the bank know that, hey, this house I bought it for principal resident, but now it's now for commercial, so that your interest rate change. Again, most people never tell the bank. They don't notify the bank. Of course, nobody want to tell the bank because it makes you
Of
pay more
course.
money. Yeah,
Of course.
yeah.
So I was going to ask so for when the after 5 years that we renegotiate, is
Yeah.
it possible that my mortgage payment every month goes down or increases?
Normally depends on the interest rate you get, and of course, normally your monthly payment should go down because your principal amount. Let's say you get a house, 100,000 house 5 years ago. After 5 years, you have already paid. After 5 years, you have already paid like 20,000. Of course, that means your balance on your mortgage is now 80,000. So
Yeah.
your renters for 80,000, of course, it will be less than your renter for 100,000. So usually what you will be paying after 5 years should be low. But why it may
Yes.
not be low depends on what interest rate you are getting now. If your interest rate before is 2%, due to rise in interest rate, your interest rate now is now 3%. You discover that you might still be paying the same thing you are paying 5 years ago or even higher, depend
Or
on
even
your
higher.
depend on your interest rate. Now, what I quickly want to say here is that for those who are in Canada already, who are listening to me, or even those who are not in Canada, one of the things that happens to help you pay your mortgage quicker, pay your mortgage down quicker, is choosing bi-weekly payments over monthly payments.
Oh, really?
Yes. If you have a mortgage and you are paying bi-weekly, you will save about 2 years of that mortgage than somebody who is paying every month. You'll be 2 years faster in paying your mortgage than the guy who is paying
Oh.
every month. So what I mean is that you are paying bi-weekly for 25
Mm-hmm.
years. By the
Mm-hmm.
end of 22 years and 8 months, you'll be done mortgage payments. Meanwhile, the guy who is paying monthly will still go all the way to 25 years.
Oh, really? So
Yes.
why is that?
The reason is because bi-weekly payments give you extra 1 month payment every year. Because bi-weekly there are 52 weeks in the year. So
Mhm.
if you are making bi-weekly payment, that means you will make half of 52, which is going to be 26. So that means you will make 26 payments.
Yes.
So
Yes. Bye.
26, if you want to bring 26 down to months, that means you are paying 13 months. Divide 26
Yes.
by 2. So that will be 13. So that means you are paying one
Mm-hmm.
month extra every year.
Extra.
Yes. So that's why of course the 1 month extra goes directly to your principal. It's reducing your principal. And when it impacts your principal, it means that you pay less in interest, you also pay, you save years. So the first thing I'm going to recommend on this platform is that if your monthly payments convert to bi-weekly, of course, it's going to mean that you pay more money, but of course,
You pay more money. Mm.
you're going to be mortgage free faster.
Mortgage free faster.
In
Okay.
addition to that, if you can do it, if you approach your bank that, hey, want to make $50 extra more payment every month,
Mm-hmm.
that $50 extra will save you another close to 2 years again of your mortgage. Now, all this thing is saving, is putting money back in your pocket because the interest rate is reduced, right? So these are ways that you can be mortgage free instead of waiting for the 25 years. In 20, 18 years, you can be done your mortgage without breaking the bank, right? That's just a side tip for people who can afford it. Of course, it means more money, but if you can afford it, it will be something that is good to do. Yeah.
Somebody asked you the question here. If you have your full down payment, do you still need a loan from the bank to buy a house?
Don't forget that down payment is down payment. That's actually a great question. But down payment
Yes.
is down payment, right? So it's not the full amount. It's just a portion of the amount you need to buy a
Of
house,
that. Yes.
right? You want
Yes.
to buy a
Yes.
house. The house costs 100,000. Your down payment, minimum down payment is 5,000. All you need is 5,000. The bank is still borrowing you 95,000. So yeah, full down payment is down
Except you have
payment.
the full money.
Of course, if you have your full money, yeah, depends also. If you have for full money, let's say you have a house cost 100,000 and you have 100,000. Is it wise for you to use the 100,000 to go buy the house and pay cash? I don't think it's wise. You know why? The reason why it's not wise is because your interest rate for the mortgage will be about 3-4% at the most, 3%. In most cases, right now, 4%.
Okay.
Rather than putting the full 100,000 in the mortgage, that is only costing you 3%. Meanwhile, why don't you put like 50,000 into the mortgage and use the other 50,000, invest it into some other mutual fund that can now give you return of 8%.
True. True. True.
So if my money can give me higher interest than the mortgage is going to cost me, why do I want to put all my money in the mortgage? So that's why usually most people don't put, even though they can afford 100%. They don't put all of it into it because the rate of mortgage is so cheap and the rates you get from investment is higher. Yeah, that's just some wise counsel there. I don't know if I answered that
Counsel, thank you
question
so
correct.
much, sir. Yes, yes. Jason Dunsin, did we answer your question or do you need more clarity? Jason Dunsin, Akomalafe, let me know if you answered your question or you need them more clarity. I was going to ask something. I hope I've not forgotten. Yes, I was going to ask this interest we keep talking about. So when I if I want to buy a house of say 100,000 now and the interest is 3.4, like you said,
Yeah.
do they add that 100? I buy. Do they add that 100, the 3.4 to the 100,000 after you have told me the money is 100,000, or the 3.5 is part of the 100,000 already? Do you get my question, sir?
Okay, you're buying a house for
For
100,000.
100,000 and it's 3.4% interest.
Yes. So
So the interest rate is added to what? To the main money or to what I pay every month?
okay, interest rate is just for us to determine. There's always $1 today is not $1 tomorrow. If I can borrow you $1 today, and you say, "Oh, don't worry, I want it tomorrow." Of course, it's going to be $1 today plus interest tomorrow. So the bank
Yes.
is not Father Christmas. So when the bank give you 100,000 for a house, the gain of the bank is
Mhm.
interest. Now, what we'll do is that the
Yeah.
interest is applied to the 100,000. So, if you divide 100,000 into the total number of months for 25 years, it's going to be about 260 or thereabout, 240 or thereabout. Now, if you divide it by the number of months, let's say you want to pay back in 5 years, which is 60 months. If you divide it by 60 months, it can come to about maybe $100. Like when you pay $100, you finish paying the 100,000 in
Mhm.
5. What the bank does is that they now have the interest. The interest that is added is now going to be at 3.5%. So $100 goes towards your principal. Interest
Mhm.
3.5 goes to the bank as gain, although the two is added.
Okay.
So if your repayment, for example, on your mortgage is $200, about $100 goes to
Mhm.
your principal, $100 go for interest, and the interest portion is the gain
Oh,
for the bank.
you gain for the bank.
Yeah,
Wow. So she's asking for that question. So does it mean when you're buying a house, you bring your down payment, the bank brings the rest for you, and then you pay the bank over time?
absolutely correct. Yeah, that's the way it works. Your down payment is your commitment to the bank that you're serious and you're not going to walk away from the loan. So you bring your down payment, the bank bring the rest, and the house is yours for 25 years.
And then you pay back monthly.
Yeah, you continue to pay back monthly, and we was actually seeing people who own. We are not going in detail. There's a detail. There's the
Yeah,
portion of refinance.
of
You can
course.
borrow from your equity in the house, but I don't think we go into all of that because that could be a little bit.
Equity in the house. Okay, that's creating my brain. But that equity is still in the bank, right?
No, what we mean by
Still from the
equity in the bank, if I can quickly talk about that briefly,
bank.
the example is that you buy a house for 500 for 100,000. You do a
Mhm.
down payment of 20%, which is 20,000. After
Okay.
5 years, you are paid additional 20,000 to the bank. So that means your equity is now 40%, right?
Yes.
Now, you can go to the bank and say, "Oh, I bought this house. The house are paid 40%. Can you borrow me from my money that I are paid?"
Oh.
So the bank will say, "Okay, no problem. That 20,000 that you are paid will borrow you. You take that
Oh,
20,000,
really?
you go use it to buy another second house."
Oh, wow. So a bank can borrow me the money I've paid. That's nice.
Yes, that's equity. So yeah, once you have equity, the banks can borrow you your equity, and you can use your equity to go buy a second
Another
house.
one.
Yeah.
So would that make my monthly payments go higher because I need to now pay what I've paid back plus the new ones?
No, okay. The way the bank does that is that your first house, you still continue to pay whatever you are paying.
Mhm.
The When you borrow your equity, the bank creates a line of credit for you. That one is
Okay.
not attached, even though your house is like security for the second one, but it's not joined to your, it's not added to your first loan. is they create a line of credit, which is where you take the money and you go use to do whatever you want to. So now you still be paying your mortgage. You now also have to pay the line of credit as well.
as well. Okay, nice.
Yeah.
That's very interesting. That's very nice. I like it. At least I can use that money to maybe start an Airbnb business.
Oh yeah, that's usually the practice when people buy the first, second, third, five. You know, you can keep multiplying houses that way.
Mhm.
Of course, you have to have good income too and good credit. Yeah, I've seen
Yes,
people that,
that's
that
how
use
good
that
credit.
to buy five houses. You know, buy house one, buy house two, buy house
Yeah,
three, and the bank is okay. You know, they keep borrowing you as long as you continue to qualify for that.
for
They
it.
just give you the loan. Yeah.
Honestly, there are a lot of loans here and there in this place. We want us to be careful.
Yeah, be
Yes,
careful.
thank you so much, sir. So if we have question, let us drop a question in the chat box so I can read it out because we spent over 1 hour. I try to keep though the conversation is very interesting. I particularly enjoy it. So I try to keep the life between 1 hour so that we don't, because in Canada per hour is something, is money. So I don't want to keep my guests for too long. So if you have question, let us ask, because for me, I've exhausted. We've treated about the business part. We've spoken about how to avoid bad debits, how to come Zion, please. So we've spoken about so many things, honestly, and this is really an eye opener. I love it. Thank you so much. So if you have question, let us drop it. Otherwise, if we don't have question, we can, call it a day. It's enough information already. My head is full. So let us know if you have questions. Let us know. Then the equity you spoke about, sir, is there any special way to qualify? I don't know if I missed that part. Like, does anybody
Yeah.
qualify for, if I bought a home from a bank, I can qualify. I don't have to have anything special to ask them to pay me what I've paid
Yeah,
back to buy.
you don't have to have anything special, but again, in Canada, everything that you have to really be careful of is your credit. Your credit
Yeah.
is everything. Of course, if you have a very bad credit, then the banks won't attend to you. They will deny you any further credit. So if your credit is good and you have the income, the sky is your limit. There's also what the bank does is called pre-approval. They do pre-approval that without you coming to the bank at all, the bank will just, and most of us that are here will see that they'll just send you an email. You have been pre-approved for,
Yes, they send me the email.
yeah.
I don't,
So every time you
they
see
send me
that,
the email very well. Yeah.
yeah, every time you either hear a call or you see an email or you go to your app and you see pre-approval, it shows that the bank love your credit. It shows that your credit is very good. It shows that that pre-approval is a credit they are giving to you without doing a hard check or hard hit on your credit.
Yes.
They are not checking your credit.
Yeah.
It's just based on the product you already have with the bank. They are satisfied. They love that you are okay. So, in order to
Yeah.
enjoy very cheap credit, and credit is everything here. I used to say
Yes.
to my customers in the bank, there are two things to avoid in Canada. Number one, criminal record. Avoid that. Number two, bad credit. Avoid bad credit like you avoid criminal record. Once your credit is bad, everything is bad. It's going to
Everything is bad.
haunt you. It's going to haunt you. I've seen people that declare bankruptcy. I can't pay back. I'm just going to declare bankruptcy, or I go to credit counseling. Those are good. Those are great way, but they never go away from you. They hurt you for as long as
Mm.
you remain in this country. One bad credit can hurt you for years and years and years. You just see people buying houses you can't buy because your credit is already messed up. Yeah, so to
So
qualify,
live in Canada without I am having credit card and all these things. Like, can I live in Canada for years without having to get the government credit or
yes.
credit card?
Yes, you can, but
Okay.
you're not gonna have many things. I don't know how many people can afford to buy a house of 300,000 and paying cash,
Without
right? If
credit.
you can, some people, due to religious belief, they don't want loan, they don't want anything to do with interest. But the problem they always have, and I've seen it quite a lot of them, the problem, number one problem they have is buying a house. If you have $500,000 cash to buy a house, so be it, go pay cash. But most of them can't. They have to come to the bank. So If you not having credit is as
Mm-hmm.
bad as having bad credit. Here,
Mm.
some people say, "Oh, I just use cash for everything. I don't really believe in credit." It will equally affect you like somebody who had a bad credit. And I'll quickly give
Oh,
example.
really?
Yes, I'll
Wow.
quickly give an example of that. If you come to me and you borrow $100, and I borrow you, I give you my $100, and the $100 I give to you, you told me that you're going to pay me back in 2 days. And after 2 days, you actually did give me back the money. So that means
Mhm.
you build a credit reputation with me. Now,
Yes.
the person that didn't borrow $100 at all from me before, that has been using his own money, and I now
Mm-hmm.
come today, how do I know his character? How do I know if he will be able to pay me or not?
Right.
So I will treat him, because I don't know if you'll be able to pay or not, and I'm not willing to give you a try. I will treat that
Mm.
person the same way I would treat somebody with bad credit. So
Okay.
not having
Yeah.
credit
True.
at all is
True.
treated as if you have a bad credit. That's why we always talk
Bad
about
credit.
building your credit. In Canada, from your day one, you have to start building a good credit. And it's building. It's almost like the way you
Mm.
build. The longer you stay here, the better your credit is.
So this she said if you rebuild your credit after it's gone bad, will it take away the impact?
If
Whether
you
it's calling me.
review it, if you review,
If
yeah,
you
yeah, it
rebuild your
depends on, yeah, depends on what makes it bad. There are some
mm.
things that never goes away. For example, if the reason why your credits went bad, if the reason is because you had a bad credit, you have unpaid bill that went into collection. Normally, if your credit goes into, so what happened is that you get a loan from the bank and you didn't repay back to the bank.
Mhm.
The bank will try to write you some letters. After about a month or two, the bank will give up on you. They will report it to the credit
Oh,
agency. Now, don't
okay.
forget that the money that the bank is borrowing you is insured. The bank just write it off. They write it off. They pass it to they sell the credit actually, because uh, they sell it to this third-party agent, which are the collectors. So these
Okay.
collectors will try to also get the money from you. They can
Yeah.
phone you, write you a letter. If you
Mhm.
don't give respond to them, it goes away. But they now
Yeah.
put it on your credit.
Oh,
Once it's reported on your credit, it's going to stay there for 7 years.
for 7 years.
7 years
Wow.
is going to be on your credit. Now, after 7 years, it's still going to be there. So the bank will still see, like if you come to the bank will see, oh, 7 years ago you had this. But even though technically we can't use it against you, but I can decide not to borrow you money still.
Yes.
So my
Okay.
own thing is that it doesn't go away. Once you have a bad credit, one bad credit, stick to your credit forever. Yeah,
Hmm.
unless you change name and you change everything. Yeah,
Thank you so much, sir. Honestly, this is very, very insightful. Very insightful. Thank you so much, sir.
yeah,
Thank you
you're welcome.
so much. Yeah. So I can see we don't have any question in the chat box. Everybody just saying it's insightful, they like it and all that. Thank you so much for joining us today. Thank you, sir. Really, I did so you can catch a replay. The replay will be available on YouTube anytime. You can just catch a replay. You can catch it. Yes, it's really a lot of things because if I'm going to have to sit him down for this, I know it's going to be a lot. So it's a lot. Thank you, sir. I really enjoyed the conversation. It's so insightful. Thank you so
Yeah,
much, sir.
you're
So
welcome.
we'll be calling it a day from our YouTube studio. If you have questions, you can drop them after if you watch a replay of this live. If it's what I can get to him, or that if you're in Canada, you can go and see him. You can consult him in his office. He works with you still work with no Scotia Bank, right? You still work with Scotia
Social
Bank,
media.
sir.
Yeah,
Yeah, he works with Scotia Bank. Hey, yeah. So if you want to get um mortgage via Scotia Bank, is this the same 5%? Do you have anything for us if you're getting a mortgage via Scotia Bank? Is there any juicy offer at the moment?
yeah. There's always because I'm not here to
For my
represent
Scotia
Scotia
Bank.
Bank. I'm not representing Scotia Bank. I'm
Good.
representing. So that's why I'm not
Yeah.
speaking about the bank.
True.
I was very careful not to mention the bank. There's a
Yeah.
limit to what I can say, but of course,
True.
if you
True.
want, there's always offer. There's always great things. You just need to visit any of the branch and ask for. They have
Yeah.
some special offer going on right now that I cannot, 100% talk
Yes.
about here.
Yeah.
But yeah, for sure, if anybody wants some special offer, you can drop some messages to you, and you can get back to me on that.
Yes. This is the last question we'll take because I was saying we should ask questions. People are not just dropping their question. Is it better to build a house or to buy one? This is the last question we'll take, please.
Well, depends really. It doesn't really matter what you do, either you buy or you build. But the only difference is that when you build a house, it's going to take you average of between 6 to 1 year before the builder will start from start. I have actually
Mm.
been opportune to build. I've built and I've also bought, so I can actually tell you about the two. Buying a
About
house,
the two.
you can
Yeah.
buy right away. You like the house, you close the deal in 1 month or 2 months, and you move on. But when you are building, you are stuck. You are there for about 1 year. You are going back to the builder, you are making correction, you are making selections. It could be a whole lot of pain, especially when you don't have time. But the advantage of building is because you can build custom spec. You can tell them, oh, I want this one here, I don't want this one, move this around, do this. They can do a whole lot of changes for you. You can actually come out with a house that you really like. But when you are
Mm.
buying the one that is already built, you just take what you see. What you see is what you get. But when you are
Yeah.
building, you have the option of putting all your own. You can say, I want the kitchen backward this way, and they will build it for you, whatever
Yeah.
you want, right? So that's the advantage of
Of
that. So it depends on you, really. So if you have time,
yes.
you don't mind
Yes.
time, you can build. But if you don't have time, you just want to buy and move on, then buying is better.
It's better. Yes, that's the last question we'll take for today. Thank you so much, everyone. Thank you, sir. I really appreciate your time and
You're always welcome.
you were so explicit and that was really great. Thank you so much, sir. I
You're always
appreciate your time.
welcome. It's always a
Thank you, sir.
pleasure. Thanks so much for inviting me, and to your audience. Thanks, everyone. I
Yes,
hope
yes,
I've
they
been
really love
able to bring
it.
insight into your building. I want to see you, if you are not in Canada listening to me. Want to see you here as soon once you get here, get
Yes,
to us. We'll help you to buy your first house here.
yes, please. If you want to buy your first, you can just indicate interest or just send me a DM. I will get you across to him. Just send me a DM on Instagram. Buffet_fella is my Instagram handle. So yeah. So thank you so much, everyone. It's bye from my studio, and then we'll see again next time when we have another program or when you see me upload a video. Yeah. So thank you, sir. Bye, everyone.
Thank you.
Bye.
Bye. Thanks so much.
Bye.
Yeah.
Yes, sir.